Certainly very mixed messages coming out of the bank this month. Historically, we've always looked at the inflation fan chart projections that they provide, and where the endpoint is compared to the market projections usually gives us an idea of what the MPC thinks about such a path. So at the moment, the path used looks for the bank rate to reach 1.25% by the first quarter of next year. And using that path, the Bank of England are telling us that it's too high, that there's going to be an undershoot for the inflation target. Now, that should have really led to a little bit of a rally in yields and a removal of some of those rate rises from the market expectations. But as you mentioned there, those MPC members that voted for 50 basis points have clearly spooked the market in terms of potentially how hawkish they are. I think for me, it suggests that the MPC want to see a quicker rise potentially in interest rates, but then stopping at a lower level. And I think that has been missed by the market altogether.
Given that you're also a strategist, does that mean that there is an opportunity here in gilts and that ultimately the market will come round to the bank's way of thinking?
Yes, I think so, especially if you were to look at them against other major markets that are only just starting to normalize. Look, if we fast forward into the middle of this year, we'll be past the peak in inflation by April, May, and then we'll be looking at a inflation forecast that's going to be trending downwards. And we've already been told by the Bank of England that their approach to forecasting energy inflation is potentially overestimating that inflation, and they're more bearish on that side. So as we roll forward, we expect the bank to have to lower its inflation forecast, especially for 2023, taking that together with a profile that's heading downwards. I can't see them raising interest rates in the second half of this year.